This podcast is produced by Linear B Group, the brand, content, and account-based marketing agency for the private capital industry. You're listening to Fund Shack. I'm Ross Butler, and today my guest is Karen Sands, Chief Operating Officer of Federated Hermes' global private equity business. Federated Hermes is a New York-listed asset manager with $770 billion in assets under management, including $20 billion in private markets. Karen is Vice Chair of both Invest Europe's Working Group on Accounting Standards, Valuation and Reporting and its Professional Services Committee, and Vice Chair of the BVCA's Accounting, Governance and Reporting Committee. She holds a degree in Psychology and Criminology and a Master's in Psychoanalysis, and in 2021 she was voted COO of the Year at the Real Deals Drawdown Awards, and she's here with me today. Did I get all that right?
You did, thank you.
Okay. Tell us a little bit about Federated Hermes, because it's not perhaps a name that everyone will know, but it is clearly very big.
Yes, so Federated acquired what was Hermes in a majority stake in 2018. That was as a result because they were looking to enter into the world of ESG and private markets, as well as really sort of diversify their offering. They're a Pittsburgh-based firm, but listed, as you say, on the New York Stock Exchange, and really sort of invested in mutual funds and money market funds. And so that's where the vast majority of the assets under management comes from. So
they didn't have experience in private markets before you guys?
No.
So they bought it?
They bought into private markets. And so it's a name well known actually in America, but probably less so in Europe and the UK. At the end of the sort of buyout period, if you will, they eventually acquired 100% stake in Hermes, and then changed the name to Federated Hermes. So now they have, as you quite reference, somewhere in the region of 770 billion of asset under management.
So you've got a big backer, but presumably they leave you alone to do your thing most of the time. And what is your thing?
So our thing, so I work exclusively on private equity, so dedicated COO in private equity. We are investors in lower to mid-market private equity. And we have a track record actually that dates back right into the late 1990s. So have been investing in private equity for many years.
Because you were part of British pension schemes.
Correct. We evolved as the captive investment arm, if you will, from two UK defined benefit pension schemes. So we have our now chair is one of the earliest investors in private equity.
So what are your goals and priorities as a business?
As a business, our goals are to deliver the best performance to our clients, so maximising returns, continue to grow the business in the areas of expertise that we have, and really to sort of ensure that we stay relevant in the marketplace, so evolving our business strategy in line with the demands of investors.
So you're the COO, so you're kind of more in the back office and making sure that everything's running smoothly. What are your goals and priorities? Same question, just from your perspective, I suppose.
So I actually, I'll say this. I don't like the term back office.
Oh, I'm sorry.
And the reason why that, and I'll say why, because I think now with the changes in the regulatory landscape, the changes in investor due diligence, actually they really focus a lot of attention on the, if you like, the infrastructure that surrounds the investment team, and so actually I actually spend a fair amount of my time with investors. So to answer your question, what are my priorities? My priorities are ensuring that we deliver a first-class service to our investors, that we've got a best-in-class infrastructure for our clients, and actually for our investment team and business development professionals alike. So in many respects, actually, part of what I do is being shoulder to shoulder with the investment team, with the salespeople, and being accountable to our investors, as well as taking responsibility for the classic funds finance teams, performance and analytics, as well as investor relations. And so all of those sort of functional teams come through to me in terms of reporting lines.
Well, I'm glad I said it now, because that's an important point. And I guess it leads me on to, how do you work with the investment team? I'm assuming that to some degree, what they do is kind of qualitative and based on intuition and their experience. And to a large degree, you're making sure that the quantitative side and the operations are there to to support them. But how do you jog along in practice then?
So in practice, I can sort of give you a few examples. So particularly if we're looking at decisions that may impact the fund level. And so what do I mean by that? If we're looking at an investment opportunity and, for example, there's a tax consideration, there's tax considerations in most of what we do. So we would look at the mandate level to see, can we do that? If so, what are the impacts on the client? So clients are always at the forefront of my mind. And actually, does it make sense for us to do that? And actually, what are the practical implications of us doing such things? So advising, supporting on transactional matters as well as client matters and fund matters. The other part of how I jog along in practice with the deal team and the sales team is really listening to the clients, listening to the feedback, and actually trying to assimilate that information as to what that means for us as a business. So, for example, if they're in a particular product and they don't like one certain aspect of a product, but they could be interested in something else, it's trying to capture that something else. Is that relevant for us? Can we execute on that? Is there a change that we may need to make to our sort of product line, our strategy around that? And actually, can we service the different products that we have if we change the modus operandi?
And how tailored is that? So are you talking about getting the general vibe from your LP base about what they like, or is it catering to specific?
My view is that there's a lot more customization in private equity now, vis-a-vis 10 years ago. And I think that's because the private equity market's evolved. I think the sophistication of investors continues to grow. And actually, investors can really customize mandates to ensure that their investment objectives are met, as opposed to going into a blind pool fund where you've got, and I'm going to say it this way, a standardized set of outcomes, and you've got like-minded investors in that product. And I think that comes down to the size of investor that you are. So are you of a size that you can sort of dictate what terms you want, or are you just looking for access to private equity and therefore you're just looking for those alpha opportunities?
What's your view of the relative attractiveness of different parts of the private markets?
I think it depends on what you're looking for as an investor. So whether you're looking for a yield return then or a capital gain-based return will really help you determine what part of private markets you're looking to invest in. From a private equity standpoint, there's been a lot of maturity in the marketplace over the years. The sort of incredible growth in the secondaries market has obviously helped answer some of those liquidity questions that have been asked out there. But for us as a firm, at this point in time, we are finding that the sort of lower mid-market a very interesting part of the marketplace, because there's the deal flow is continuing to grow. There's a lot more opportunities, investable opportunities in that part of the market. And so what that also means is that the opportunity to exit remains out there, and there are options to exit. So whether that be through a trade buyer, an IPO, the classic routes of private equity, we're finding that they're still existing within that lower mid-market. So for us...
And secondary?
And secondaries as well. Secondaries, whether it's GP-led or LP-led, that's helping solve the sort of the liquidity question that investors are asking all of the time. And for us, it just really helps us put together a portfolio construction that addresses the needs of the investors. So if you put some secondaries in there, you can get that element of cash coming through on a almost, a more frequent basis. If you put the co-investment portfolio, you've got the capital gains that are coming through at a sort of more of a midterm perspective. And so for us, we see that. And if you put primary funds in there, obviously you've got a longer term growth path to come through. And so really that's sort of what we're seeing as really interesting in the marketplace at this point in time.
You get buy and build strategies, which means that you can invest in a lower mid market, but actually you're getting almost kind of like the low end of the SME market by default to some degree if they follow that strategy.
Yes. And so really we look at anything, we're looking at deals with enterprise value of anything up to 500 million. So we can invest in something that's 100 million, really, because it depends on what the opportunity is that presents itself.
So Tell me about your target operating model. What are your priorities there?
So I think if I can maybe articulate it in this way, I'm a visionary by nature, actually. So I like pictures, and my team will tell you I often draw very badly pictures, and then they make them look a little bit more professional by using PowerPoint. But I see the target operating model, and I'm going to explain it almost akin to a fund, where there's 3 levels. You've got your asset level, you've got your fund level, and then you've got your investor level. And what a target operating model does is it's really addressing all 3 of those components. So typically what we'd have, or firms would have, is a portfolio management system. So a system that captures all of the information around the investments. You then have your fund level. So you typically work with a fund administrator, or you might do fund administration in-house. So you've got your fund level information. You then look above that, and you look at your investor level. So your investor level would look at your CRM system as well, so where you've got all of your information around your investors. Your funds, dropping back down one, with more your sort of, I'm going to use the phrase, traditional general ledger accounting type system or performance system. And actually what the target operating model does is ensure that all of that data is being captured in some sort of repository so that you can access it. And I'm going to use the phrase manipulate, but adjust the information depending on the question that's been asked for you. And so what that means is that actually where the world is going and has been going, and when I say the world, the private equity world, is that it's important to have this data repository that's collecting feeds from your portfolio management system. It's collecting feeds from your fund administrator. And if you do benchmarking, you've got feeds from whatever benchmarks you're using going into that system. And then you can extract that information using perhaps something like a Power BI tool, where you can change the data so you can answer the question that's been asked of you. So it may be an investor saying, what's my exposure to healthcare? And so your particular investor, you need their exposure to your fund and their underlying exposure to the healthcare sector and all of the measurement that goes with it. And so I think the target operating model enables businesses to be robust but scalable, yet flexible all at the same time. And I realise it's using those words in that phrase may seem a little counterintuitive, but that's what it does. So your ability to leverage the system means that you can continue to grow whilst not overloading your overheads, or ensuring a disproportional. You're ensuring there's not a disproportional growth in your headcount relative to the increment of revenue or AUM that's coming into your business.
So that's a really clear summary. Thank you. So you've got these kind of 3 conceptual layers of your business, and it's all feeding into a single data repository and then you can interrogate that data repository with questions that pertain to all of those levels. And so you gave an example of an investor wanting to know their exposure to healthcare. So back to reality, if an investor did ask you that question, could you just plug that question in and some AI will spit out the answer, or where are we?
I suspect that's where we'll get to. And if there's not people working on that as we speak today, then I'm pretty sure that they will be. And to give another live example, the Silicon Valley Bank event that happened, so many investors were going to their GPs asking for their exposure to Silicon Valley Bank. And so if you've got this target operating model where you can capture the different counterparty relationships that you've got, it just means you can respond quite nimbly to the questions that are coming up. But I suspect you're right, the evolution will be such that someone will just type in a question and the answer will come out. But you're only as good as the data that you capture. And so I guess the starting point is what data do you want to capture? And me being me would be, well, I want to capture it all. But there's parameters that you need to operate within. So I think it's an interesting space to watch. And I think that the unique identifiers of sort of, I'm going to use this phrase of client service, client relationships, it will be those GPs that have actually embedded or put a lot of investment into their internal technology infrastructure, because it will give them a slight competitive advantage from a service perspective.
A quick break from this episode to give a plug to Linear B Group. If you're looking for a communications and marketing agency that really gets you and gets your market Our senior team of marketing, editorial and creative professionals could be the perfect fit. So get in touch at www.linearb.media. We're the folks behind Fundshack and many of the biggest private equity brands and marketing campaigns you will have seen, and we can help you too. Back to the show. Where are we in terms of, so someone's got that inquiry about what's my exposure to healthcare. What would you actually have to do today to get them that answer?
So today you'd almost be sort of pulling information out of, potentially sort of two systems. So you'd be looking at your portfolio management system, then looking at what their percentage interest is in the fund that you manage and putting the two together, likely going through some sort of going through the IR team and putting it into a client-ready format. So the IR team will gather all the information, put it in a client-ready format, and then you deliver it to your client. And that would be whether it's through a secure portal, whether it's via email with some sort of encryption, again, paying recognition to the cyber threats that are out there. So it's still reasonably intensive to answer a pretty simple question.
Right. Can we talk about maybe risk for a while? What does risk mean for your organisation? How do you think about risk? But maybe it's different from a COO's perspective as well. Maybe that's a different kind of risk.
Yeah, I think there's different levels of risk, isn't there? There's enterprise risk, there's operational risk, there's key person risk. So I think you've got.
Yeah, I've opened a can of worms here.
Yes, you've got multiple layers of risk, and I think you've got client risk as well. And so, I think as a COO, the answer to your question is you have to think about every single dimension of risk. The luxury that you probably think less about is investment risk, because you've got a CIO that can run with the investment risk, but as opposed to sort of everything else, you're running with that. But even as a COO, you still take into account investment risk, because you're looking at the performance that you're delivering to your investors. But critically, I think you do need that multidimensional view of risk.
What about liquidity? Is that your department?
Liquidity, in the sense that if clients ask for liquidity and they want, and it comes up more and more, or what's your forecast of liquidity over the next 12 to 18 months, then, ensuring that the client request is answered, then yes, that comes into my world. But where it's coming from, that's with the investment team. Yeah. So what my role does is ties through the ask and the relevant functional teams to ensure that we've got systems and processes in place to deliver that to the clients, as well as, of course, ensuring that the cash actually does come back. So you've got that financial control element that comes into that process.
What's the rhythm and cadence of you and your team throughout because it's clear for an investment director, they have if they're doing direct deals, it's like that. And for an investor relations person, it's full on when they're raising the fund, and then there's a steady communications job. What about from an operations perspective? When do you get really busy, and when can you sit back?
I've thought about this question quite a lot, actually, and it comes up frequently. I don't think there's ever really a downtime in operations. And when we say the word operations, I think you're talking about essentially everything that's non-investment related.
Well, I'm trying to find a phrase that's not back office. Or,
Yeah.
Yeah.
And I think actually, I think the answer is in operations. You've got, it's harder to see the peaks and troughs. Clearly, you've got peaks when you're delivering your audited financial statements. You've got peaks when you're at quarter end, when you're doing your valuation reporting, your investor reporting. But actually, the period in between remains constant, because even though you've got typically set fundraising periods, you're always fundraising, because you're always engaging with clients. So you're always thinking about the next fundraising cycle. And your deal team are always investing, or they're realizing deals, or they're monitoring, or they're dealing with whatever topic is coming up. And so actually from an operational perspective, I think it's harder to identify the sort of the troughs, as it were. And really it's almost steady state, with the sort of the peaks coming up on a regular basis.
Sounds like you've almost got a proper job. It's rare in private markets. Sorry. Let me go back to something you said earlier about, I won't put words in your mouth. People and your team. So if you were to ask me, Carl, I'd say, well, what you need is, highly numerate, basically accountants, very good calculators. But you said a very unusual word, which is empathy. What are you actually looking for when you're hiring?
So I think it depends on what role you're hiring for, but as a general rule of thumb, what I'm looking for is not just the highly numerate person or professionally qualified people. So whether you're an accountant, CFA qualified, CAIA qualified, but actually it's looking at the sort of the qualitative skill set as well. So the ability to read and write. I think, and I say that as someone that's a qualified accountant, and writing doesn't come naturally to me.
It's always ChatGPT.
Yeah, I should try that. Won't get through the cybersecurity though. And actually, I think emotional intelligence, and I think that that's a hugely important skill set to have somewhere within your team configuration. And that recognizes that different personalities have different traits, but that emotional intelligence can sometimes be the difference.
You need a bit of diversity in your team.
You need diversity. You need diversity of thought. And I'm a real believer in the diversity of thought, because otherwise you're sort of pre-programmed for everybody to have the same outcome.
Yeah. I think you don't need diversity if you only have short-term goals, but if you want to keep going, things change. Anyway, that's another. You also are very active on the industry stage with various roles that I mentioned at the start. So can you just give us a little bit of insight into what you do on those committees and why it's important?
Yeah, at some point in my career, I realised that it was all very easy to sit on the sidelines criticising, making judgments, saying, oh, that's wrong, this is wrong, why didn't they do it like this? And so rather than being a sort of someone that sat on the sidelines, whispering behind the scenes, I thought, your best place to take a role and try to influence better outcomes for the asset class. And so as I grew in my career, I was asked to join Invest Europe. Really, sort of, the first role was on the valuation, reporting, and accounting group. So I joined that group, and again, I think one of the sort of beauties of Federated Hermes private equity is the vast exposure that we've got in the private equity market. And so you see different things. And so the ability to sort of provide a view on something that you've seen and whether or not that works or it doesn't was really quite helpful. And actually in hearing other people's challenges or something else that needed to be adjusted depending on what they'd seen as well. I found it really interesting.
So give us an example of kind of hot topics that you're looking at the moment.
So I mean, these are all out there. I think valuations, the sort of the scrutiny around valuations.
Where do you stand on that?
I think there's most GPs and LPs are very familiar with the IPEV guidelines. You referenced them earlier. They're a robust set of guidelines. More often than not, they're embedded into LPAs, which clients signed up to. They sort of acknowledge accounting standards. And so I think the implementation and the approach around valuations is very robust. And I think what the outside looking in doesn't know or doesn't see is they don't understand that framework exists. And I think that there's an education piece required of private equity to let people know that there are IPEV guidelines. They do fall in line with accounting standards, and this is very tried and tested, and LPs recognise that these standards are in place. So for valuations, I think it's tried and tested. And there's scenarios where it makes sense to have an independent valuer. There's scenarios where you're sort of still connecting and looking at comparable companies to triangulate data. So as you can hear, I'm very positive. But I think there is an education piece needed for those that aren't within private equity.
Do you think it conceptually makes total sense to value companies individually when they're part of a fund?
Yes, I think you do, because we referenced risk earlier. I think you do need to value individual companies when they're part of a fund, because you need to look at the impact that one single company would have on the fund as a whole. So from a portfolio construction perspective, I think it's really important, and also to ensure that you are backing the right companies. So I think you do need to value individual companies. But when you're looking at a fund of a whole, or you're looking at the sort of impact on the broader sort of, if you're an institutional investor, what that means for you, obviously you've got proportionality to take into consideration.
Okay, so that's valuation. Anything else you're looking at?
There's, I think ILPA have issued guidance on continuation vehicles, NAV financing, they're topics that will come up. Invest Europe, the investor reporting guidelines were recently refreshed, and ILPA have issued a consultation process again to look at their reporting guidelines as well. So those topics will continue to go on over the coming months. Personally, I think that there's a topic that will come up more relative to some of the challenges in the fundraising scene around performance measurement. So calculations of MOICs, for example, and then particularly how that relates to...
What's that stand for?
Multiple of invested capital. And I think that the other thing that will come up is benchmarking and some of the challenges within like-for-like benchmarking. So how does GPA measure themselves against GPB? And I think that will come up as a topic in the next 12 months.
Why, and what's the current standard?
So I think there's various different benchmarking names out there, but I think it really drives from, and it will come out of the sort of the review of quarterly reporting. I think it's some of the challenges that LPs are having, looking at the impact of GP performance. So I think it will come up, and I think the challenge with the MOIC is the denominator effect. What denominator are you using? And that will come up in discussions. The other point that come up as well is the focus on DPI. So on a business that's cash on cash, are investors paying, looking at that DPI return as well as the IRR? And so my view would be that whilst IRR remains relevant and important, I don't think that that's going to continue to prevail. And a lot more focus will be around the DPI, the TVPI, and really the sort of almost like a triangulation of performance measurements, like we have in valuation.
But don't you get all of this information anyway, and you can decide as an LP what you're going to focus on?
Yes. All of this information is largely disclosed gross and net, with and without the use of facilities and NAV lines. And I think as an LP that information is available. But what I think again is potentially missing is the education piece, as well as to why some of these metrics can be more useful than others, depending on where you are in the market cycle.
Yeah. What's your view on the general market at the moment? Because it's been a very difficult fundraising period.
I think that remains the case. I think it will continue to be. I think some GPs are beginning to see some green shoots, but I think the fundraising challenges will continue, particularly with some of the macro events that are happening at the moment, and I think that there will be over the coming years almost a rebirth of private equity, if I can put it that way, because the asset class has matured over the last 20, 30 years. And now what we're seeing is some of these emerging managers coming up really challenging some of the status quo. And I think that means that there'll be an impact on that. But fundraising will continue to be a challenge because investors are capital constrained. There's a focus on liquidity because liquidity has been dried up over the last few years. And so I think that it will stay that way until that there's a change in the macro, because the macro impacts what your investors are allocating. Do
you look at emerging managers to invest in?
We do look at emerging managers, and we invest in emerging managers, yes.
So when you say there's going to be a change coming, though, I mean, what are these people coming up with that's new, that's not the same old private equity model?
I think, again, it's made me sound some sort of like grand philosophizer. Maybe we won't include that bit. I think it's just the challengers, the disruptors, the emerging managers are disrupting, and I think it's the debate of the asset gatherers versus the people that are really driven to deliver. And I think that's the debate that's been in the market for some time. But now, if you look at the performance of emerging managers relative to sort of seasoned managers, that there is a difference coming.
Yeah.
It's whether or not the risk appetite of investors changes as a result of that, i.e. that they're more willing to go down that route. And I think with emerging managers, people tend to think that it's inexperienced investors, when actually it's quite the contrary. They're seasoned professionals that have typically come out of household names, private equity names.
Yeah, it's just, but the risk is different because they're even if they all come from the same place, it's not the same thing.
Correct. They've got different backers. They've got the financial backing is very different to where they have previously come from, and
their systems and processes are all new, and everything's new, and so they might be the rainmaker of their old firm, but it's a different situation now, and so I can see why people are more wary, but it absolutely has to happen, otherwise you kind of just calcify as an industry.
Yes.
I have a question that I've got to ask for social media reasons, and it's like, do you have any advice for career-wise? Do you have any advice to young people looking to start a career in private markets, perhaps on the operations side of things?
Yeah, my advice would be to build your network early. So what do I mean by that? Talk to people who have been in the industry, talk to people who have experience. If it's more operational, just talk to peers as to how they got into the industry in their sector. So I think that ability to build your network quite early on, it takes a long time to build a quality network. And actually some of the most informed decisions come from collaboration, seeking advice, seeking guidance for you to then make your own informed decisions. And so I think for me, that's one of the best pieces of advice that I could give to anyone coming into, whether it be private markets, private equity, finance, or otherwise, is to really build your network and make the most of some of these opportunities that are out there. And actually don't lose the ability to speak to people. And that's why talking to people, I think, needs to be something that the next generation of people coming through needs to continue to work on. And I say that because I know my 15-year-old daughter hates talking to people, and if she can order it through an app or she doesn't have to speak to someone, she will do that. And I think that art of talking,
it's a generational thing.
Correct. And that's why I say build your network, build the people that you're talking to, and actually, and I'm not sure whether this is an age thing, but the world is a small place, and you never know when you're going to cross paths with people. And so sort of maybe being a little bit, I would also say you treat people how you want to be treated yourself. So make sure that payback comes back positively. So
there's an external perspective, which is, it's the smartest guy in the room type perspective, which is it's all about brute force intellect. And that's never the answer I get whenever I ask this question. Is the answer is always about something about people. But it's interesting, even from your perspective, when you're on the operations side, presumably you need very analytical people, highly numerate, as we've just said. But that's still your answer. So that's
it is, because you can be the best technical expert in the world, but if you cannot convey your point and
bring people with you,
or you can't convey your point to an investor, a regulator, or whoever it is, then the sort of opaqueness still exists. And the idea is it's answering a question that's easily understood, that's relatable, and people can then understand and make a decision of, if it's a decision-making question.
Which part of your job do you enjoy most?
I like the people side of it, actually. I like the people side, and I like problem solving. So you put the two together. It's for me, it's really interesting, and no 2 days are the same. And I think that vast array of different things, if I can put it that way, that I deal with, are really interesting for me, and keep me energised.
Great. Karen, thanks so much for sparing the time for Fund Shack. It's been really interesting speaking with you.
Thank you.
You've been listening to the Fund Shack podcast. If you like what you've heard, click follow on whichever platform you're listening or watching on, and visit us directly at fund-shack.com. It's got a treasure trove of private capital insights. Thanks for listening.